Stop. Wait. Don't close this screen. Not yet. Watching this Monday night? Perfect timing. Because on Tuesday morning, while you're making tea, going through your routine and thinking about what the market might do, some traders will watch their portfolios get cut in half. Some accounts will flatline to zero, and some will stare at their phones in disbelief, asking, what just happened? The CME reporting system has gone dark, a complete blackout. Price discovery, the DNA of every chart, the soul of every candle, is on life support right now. If you don't understand these 6 signals in the next 8 minutes, you won't trade the charts. The charts will trade you. You won't be the player. You'll be the pawn. This isn't a drill. This is happening now. Picture this. Tuesday opens at 9:30. You've done your analysis. You're confident. You hit buy. And your fill shows 2% above your entry. Slippage ate you alive. That trader? He used you as exit liquidity. It's a simple equation. He's the wolf. You're the sheep. And after a blackout weekend, the wolves are starving. Here's a lie 95% of traders believe. On Monday, the market is closed. Wrong. Trading is closed. But the system never stops. Clearinghouses are reconciling, calculating who owes what. But this weekend, that data is blurred. It's fogged, fractured, unreliable. Timestamps are stale. Delivery notices are stuck. The scoreboard is completely dark. When the scoreboard goes dark, algorithms panic. They have to decide, quote or quit. The core problem? Risk models aren't getting fed. Decisions without data are based on assumptions, and assumptions are expensive. What separates the 1% from everyone else? You trade based on volume. You think volume is high, it must be bullish. Wrong. Volume is noise. The real signal? Issues and stops. Issues mean someone demanded delivery, actual metal. Stops mean metal was claimed, physically left the vault, gone forever. For example, 100,000 contracts are traded, but the issues plus stops? Only 1,200. That's 99% paper churn. Now, flip it. Volume is normal, but issues and stops spike to 15,000. Something big just happened. Paper and reality just welded together. Margins will jump. Shorts losses become overnight payable. Volume is noise. Issues and stops are reality. Here's a secret from the trading floors. Professionals don't see crashes. They hear them, they feel them before the first candle even prints. 3 signs. 1. Spreads widen dramatically. 2. Top of book size shrinks. 3. Quoting slows, market makers go silent. When all 3 align, market orders become punishment. That's why after blackout weekends, candles aren't clean. They're violent and predatory. Here's your early warning test. Think of the spread as your smoke alarm. Normally, there's a gap between New York paper prices and Asia physical prices, and bots close that gap in seconds. But what if the gap stays open? Nobody's picking up free money because there's doubt in delivery, there's risk in settlement. Trust itself has become taxable. When the bridge cracks, prices become isolated islands, and in those dark waters, that's where sharks feed. Now, a truth that might keep you up. Your gold ETF, your futures position, what are they actually? Price exposure. Pixels plus someone's promise. In allocated physical, there's less promise and more control. The blackout stress test asks, if I need to exit today, will it work? If I need delivery, will I get it? If your answer is, I don't know, then listen. If you can't withdraw, you don't own it. You're a claimant standing in line. Tuesday opens 3 doors. Door A, glitch fixed. The surface looks fine, data is normalized, and there's a relief rally. But the spreads are still 2 to 3 times normal, and liquidity is paper thin. The trap? Violent whipsaws and stops get hunted. Door B, confidence event. The delay gets an excuse, but the market doesn't believe it. Market makers pull their size. A gap open is incoming, it's whipsaw city, and you're caught in the crossfire no matter which side you picked. Door C, rule risk fear. This is the most dangerous. The exchange hikes margins by 50%, and settlement notices flood the system. Physical premiums spike, and the paper side de-risks. Paper holders get crushed. Physical holders collect the premiums. Don't guess the direction. Observe the door, read the tells, then decide. Screenshot this now. These 6 signals are your pre-market checklist before 9 a.m. Signal 1, CME backfill check. Examine the timestamps. Are they fresh? Green light, stale, or missing? Red flag. Signal 2, basis spread analysis. Is today's spread 2 to 3 times wider than normal? Liquidity risk is on. Signal 3, dealer reality check. Call the physical dealer. Ask them, is gold in stock? What's the delivery lead time? Are there delays? Higher premiums? That's a distress signal. Signal 4, liquidity feel. Wide spreads, shrinking order book size, long wicks on the candles, small orders moving the price, all red flags. Signal 5, exchange advisories. Are there any halts? Margin hikes? Has the settlement wording changed? You need to be in alert mode. And signal 6, cross-venue sanity check. Are New York, London, and Asia prices aligned, or are they disconnected? Is an ETF's net asset value unusual? Something is broken. Here's the action plan for traders. Rule 1, market orders are banned on Tuesday. Use limit orders only. Rule 2, the first 15 to 30 minutes, skip it or use half-size maximum. That's the slaughterhouse window. Rule 3, position size, cut it by 50%. Today is about survival. Rule 4, if the spread is 2 to 3 times normal, no trade. Period. Rule 5, use bracket orders with a stop loss and take profit preset. Add a slippage buffer. Rule 6, have a kill switch. 2 bad fills. Back to back, walk away immediately. The market will exist tomorrow. Your capital won't if you destroy it today. For investors and stackers, Rule 1, panic and FOMO are both your enemies. The premium is also a price. Patience is your strategy. Rule 2, allocated always beats unallocated. Check your storage terms, verify the serial numbers, and ask about audits. Rule 3, test before you scale. Try a small redemption first. If you feel friction, that's a red flag. Change your provider. Rule 4, for ETF holders, watch the NAV premium or discount. An unusual spike means something's wrong. Convenience or sovereignty? Choose now, not during a crisis. Here's the bottom line. When data gets unclear, clarity falls, liquidity gets scared, volatility jumps. Even if Tuesday behaves normally, if you ignored this warning, you'll be trapped in reaction mode when the real move comes. Your decisions will become emotional, fear-based, and devastatingly costly. This is Money Mind Hub Pro. No hype, no clickbait. Just high signal risk mapping. Subscribe and hit the bell. Because Tuesday at market open, I'm going live with this exact checklist. A real-time breakdown, signals analyzed, all happening with you. Tuesday morning, be there. Stay sharp. Protect your capital like your future depends on it, because it does. This is Money Mind Hub Pro. See you Tuesday.
Disclaimer. This content is for educational and informational purposes only and does not constitute financial, investment, or trading advice. Trading commodities, futures, precious metals, or any financial instruments carries substantial risk of loss and may not be suitable for all investors. Past performance does not guarantee future results. Always conduct your own research and consult a qualified financial advisor before making investment decisions. The creator assumes no responsibility for financial losses incurred from acting on information presented here. Trade at your own risk.